So what's this whole macro pill thing that you've been tweeting about?
So basically, it's a play on what the Bitcoin maxis like to call when someone goes from not knowing anything about Bitcoin to becoming a maxi, and it's called orange pilled, right? Like if you get orange pilled, like you get converted into basically a Bitcoin maxi, or you get your eyes open to what Bitcoin is,
Yeah.
and its benefits and its hyper adaptability or adoption, etc. Right? And the macro being macro pilled is pretty much the same thing where you have this large audience specifically on Twitter, right? That doesn't know much about macro to begin with. They haven't really studied it. They haven't seen enough. Obviously, if they're coming from legacy media, like the major um, television networks and whatnot,
Like reading The Economist, those people.
right. Like you're not going to be exposed to what you're exposed on Twitter. That's why Twitter is a great place and also a harmful place at the same time, because the amount of drama and multi-directional takes that you can get in just scrolling down is very, very, very wide and vast, right? So you have someone that doesn't know much, and they'll read one thread, right? And they'll figure, okay, I kind of have an idea of what's going on here. Maybe you really don't, and you're just like, well, maybe the reason I don't understand this completely is because I don't know enough. And the answer of not knowing enough is being macro pilled. Like you're like, okay, I need to understand every facet of every angle of how this all works, because if I don't understand how every little thing is connected and why every little thing is connected, everything from simple interbanking plumbing all the way down to just basic growth and inflation understandings, if you can't put all those pieces together, you're almost seen as not being able to put the puzzle together and failing in the space. So that's this idea of being macro pilled, right, where you have to just go in and dive in and understand everything all at once. And what ends up happening is you spend a lot of time focusing on shit that just does not matter, right? Like this BTFP thing, the Bank Term Funding Program, right? We got some news this week that it is in fact going to end in March, and it'll any outstanding loans will be that are open before then will be allowed to expire. So if someone opens a loan, obviously before the end of March, they have 1 year term, and then it's over. But the program itself is closed, is shutting down, and people are automatically wondering, oh my god, how is this going to affect the regional banks?
Yeah, they're
What
gonna
is this
blow
going?
up again. We're gonna
Yeah,
have another
yeah,
SVB situation.
right. And they're trying to put one and two together. They're like, oh my god, maybe the regional banks aren't going to survive this. If the regional banks don't survive this, what are they going to do? Are they gonna be forced to sell treasuries in the open market? Is that going to push yields up? And this is the whole type of macro pill theory that goes through their heads, and it's all nonsense. You can't focus too much on these little things. There will be things that happen in macro that you can see coming, but there will be a lot of things that just happen that you don't see coming. Okay, for example, SVB. This entire SVB issue, it was explained as a possibility of happening for a long time, especially when rates went up the way that they did. But it was only when the bank runs started happening that things started accelerating. Now, no one could have given you that time frame, right? When exactly that was going to happen. It was a possible risk. It's always good to understand possible risks. But obviously based on the stock market, where the stock market's gone, and the situation at these banks, unless you owned equity and not and not cash at the bank, right? As long as you weren't a shareholder of the bank, you walked out just fine. There was no real harm. So there was a lot of drama, but the Fed was able to manage and patch up the bullet holes with band-aids and pretty much resolve any issue.
Yeah, and it's a good lesson learned. Like there's always going to be a risk. There's a reason why the S&P averages almost 10% a year. Like you're going to have risks with stocks, and you can't possibly know all of these risks. And these people that are macro pilled, they're looking at every possible angle. Oh, there's the BTFP program that's ending. There's Taiwan that's going to be invaded by China. There's the Federal Reserve is stuck between a rock and a hard place. There's always going to be something to be worried about. And that keeps a lot of people out from investing because they're just so scared. They're scared to put their money into stocks because there's so much risk involved. But a lot of that is out of your control. It's out of you can't predict it. You just kind of got to go with the flow, and at that point the way you survive in this environment is with proper portfolio allocations. And we have our system, which gives us a guideline depending which regime we're in. There's in deflationary and stagflationary regimes, the odds of things going bad are higher, and we adjust our portfolio accordingly. And that's really all you can do. You can't possibly predict every little thing that's going to happen and cause stocks or bonds to crash. You just got to be prepared for it at all times based on your portfolio allocation.
And that's why having a data dependent system is very, very useful in this situation, right? So I'll give you a little hypothetical scenario here, right? Imagine you're driving down the road. Now there's a pedestrian walking on the side of the road, right? Maybe that pedestrian's on a bike, on a scooter, doesn't matter. Maybe the pedestrian's wearing a green or red shirt. Again, doesn't matter, right? The fact there's a pedestrian there is the key factor here, right? The macro-pilled individuals want to know everything about that pedestrian before they pass them. They want to know, what gender are they? Are they tall? Are they short? Are they overweight? Are they underweight? They want to know everything about that person. Meanwhile, the proper approach is to address that there is a person there. Be careful. If that person is on a bike, they can maybe fall into the street. You could hit them. Be cautious. That's about it. That's all you need to know, because you're going to pass them and then you're going to be on your way. Whereas the macro pilled will slow down. They'll be too afraid to cross. They'll want to know everything about the situation, and then boom, the opportunity passes them and they're sitting there holding the bag. That's the problem. You have to know when to stop and when not to. And that's just something that really just comes with experience that you're not going to know right away. And the problem is these individuals that are newer in the space, they hit this road bump where they're like, oh my God, I need to know everything, because either I know everything or I know nothing at all. And that's completely wrong. But the problem is you have a lot of people in this space pitching you on this idea that they have all the answers in terms of knowledge and that you know nothing. And unless you know what they are about to tell you or what they know, you are at a disadvantage. And that's really just that's false advertising.
I think the hardest part of trading and investing nowadays is just the amount of misinformation that's out there. It's just a minefield that people have to dodge, especially new people that are new to trading, new to investing. It's like there's so many scammers out there. There's people just feeding just nonsense information as if they know everything. And it's so easy to get caught up in these things that just don't matter.
That's 100% true. And let's talk about some misinformation, right? We had GDP come out this week, real GDP numbers for quarter four of 2023 at 3.3%. Obviously, the quarter prior to that was 4.9%. So pretty much a string of I think 6 positive quarters in a row now of real GDP growth, with the 2 in 2022, which the market pretty much saw this drop coming, and that's what we saw in 2022. Obviously, the quick reversion here and back to positive territory, the market didn't see that part coming. It saw the slowdown, and that quick snapback is what the market obviously sold off or got oversold on, and then rebounded hard on, was the fact that we were not, in fact, going into a recession.
And
but
speaking of misinformation, how many people on Twitter were calling for a Q4 recession in 2023?
Oh, ridiculous.
Everyone was expecting a recession. And you know how it goes. When everyone is expecting something, it's not going to happen. And actually, the opposite is going to happen usually.
That's kind of like where we are right now in the compound landing process, right? Like we're burning through stage 3. Stage 3 is burning hot. Out of the 4 stages, we're in stage 3, so we're 75% of the way through it. And stage 3 is burning hot, and everyone's claiming the soft landing's here. And we went over this in last week's podcast. That's very likely the soft landing is going to materialize. In fact, we actually call it the impossible soft landing, because it's only if you don't look through a scope do you realize that the economic cycle exists and functions as it always does, and you're just pinpointing a specific point in that economic curve and claiming success, when in reality, what comes next, people aren't going to like, but it will come at some point. And everyone is trying to predict that rollover. Now that's where the misconception is, and that's where a lot of this misinformation, like you said, this Q4 recession is coming from, because people are looking for, people said this is going to be the peak GDP print, which so far it has been 4.9%. But that just because you're not at 4.9% and you're stabilizing in the 2 to 3 range, 1 to 3 range, you're doing just fine.
Yeah, and stocks
And
can still go up in the 1 to 3 range. You don't need to be at
right,
4.9 to make money on stocks.
right. And that's a big issue that we're running into right now, where people are, I mean, we want to talk about misinformation. We have everyone saying that the government's buying the print, right? So to a degree, government spending is, in fact, contributing to GDP growth. That's understandable. This is real GDP growth too, though. This is not nominal. So adjusting for inflation, where inflation is, it is positive on exceeding the cost of inflation. So there's real growth here at the moment. And as long as that continues, there's regimes for this in our system, which our system has been sniffing out and telling us what to do, or not so much what to do, but what to look for. And as long as this continues, the drums will beat on. Now, this brings us to the next point of conversation, which is inflation. Obviously, inflation numbers have been coming down. As we said, they really would. The risk in inflation isn't the same today as it was 12 to 18 months ago. Things have changed along the way. And we can look at the 5-year inflation expectations that are priced through inflation swaps. And you can see here that we are sitting around 2.39%. Now, I've brought up this chart multiple times, and I've made it very clear that just because it says 2.39% does not mean that we're going to see 2.39% in 5 years, inflation in 5 years. That's not what this is chart's telling you. What you need to pay attention to here is the direction of what's going on. So think of inflation like a tide or like a wave, right? It's going to roll in and it's going to roll out. So if this is coming down, it's telling you that there's negative inflation pressure in the market. If this is going up, it's telling you there's positive inflation pressure in the market. If this is going sideways, like it has been since December or January of 2023, so over a year now, it's telling you that inflation has pinning risk, meaning it's got this stickiness factor that in this range of 2 to 3%, that you have to pay some attention to, because it's not indicating that inflation is going to go right down through the Fed's target yet, meaning it's going to stay where it is kind of right now and pin sideways, and that's something the Fed does not want to see. So this is not so much telling you that inflation is above trend still. This is telling you that inflation is not deflating at this point in time as it should be, because it's going sideways, and therefore a higher for longer environment is likely the outcome here until something breaks. And this brings us precisely back to the compound landing being the move from stage 3 to stage 4, right? This idea that the Fed is going to over tighten or stay too tight for too long and not bring interest rates down efficiently is going to lead them to basically over restrict the economy at some point. And in that scenario, when we get to that stage 4 where the economy is basically over tightened, what you would see, or what you should be looking for in these inflation swaps, is them diving lower, kind of like this, right? But instead of going from 3.5 down to 2.5, they would be going from 2.5 through into the ones, right? They would be going right down under 2 and then into the low ones. That's what you would see in a real recessionary environment, where an over tightened slowing growth environment. We're not seeing that yet. We're seeing this pinning action in inflation swaps, so the Fed can in fact hold higher for longer, and that's something that we're saying, look, 5 rate cuts in 2024.
That just doesn't make sense.
It just doesn't make sense. The Fed obviously has to start cutting interest rates, but we're talking about cutting 25 basis points at every meeting. We laid this plan out, I think, at the end of last year, in December of 2023. The Fed should have come out and made a plan where they'd cut it every other meeting. Something very very structural to make sure that obviously if they had to cut, they would do so in such a planned manner, but they can't, because the way the market would take that and extrapolate it, then they would think, oh, not only 5 the Fed penciled in 3 rate cuts and the market took it to 6, right? So if the Fed said they were going to do 1 at every other meeting, the market would then run away with that, and probably we'd be pricing in 8 to 9 rate cuts, right? So that's the problem. That's why the Fed is almost hindered by their own abilities. Long story short, the Fed's going to have to bring interest rates down at some point this year. I do think they're going to cut interest rates. It's going to be significant. I don't think so. And I think that's what the bond market and just even the bond market with 6 rate cuts is not appealing to what, or is not acting as the way it should in a growth slowdown, because those 6 rate cuts are just the Fed coming back into line, right? That's not because we have a recession. And that's what the market was able to pick up and realize, and why the market's been able to run so well, because it's basically taking it as, okay, we got 6 rate cuts, anywhere from 3 to 6 rate cuts, to kind of realign the Fed in a more neutral stance, neutrally restrictive, not overly restrictive. And in the process, there's no recession. Stocks get the bid. Bonds go kind of sideways, and they can grind higher, but they're really not the bullish asset that they should be, or they could be, in a rate cutting environment, specifically because the rate cuts aren't driven by a dramatic growth slowdown. They're driven by an inflation slowdown. And that's where we go back to inflation, right? Inflation slowing down. The issue again, we have this Red Sea conflict. Everyone's complaining. Everyone's, or I should say, claiming the second wave of inflation is upon us. And they're giving you all these stats about 1980s, about container prices, about how the container prices between through the Suez Canal is so correlated to our inflationary numbers in America, which doesn't really make any sense. You
It's
could say,
because
yeah,
fear sells. At the end of the day, fear sells, and fear is what attracts people that are just getting into this. It's very easy to be afraid,
right.
and
And
you just miss out. If you're always
yeah,
afraid, you're never going to go triple leverage long Nasdaq like we do. If you're always afraid.
right. Yeah, you're always going to end up worrying about the drawdowns and not the run-ups. And long story short, as long as you understand the drawdown, the capabilities of those drawdowns and manage them correctly, the run-ups are always going to be longer and better than the drawdowns. But speaking of inflation here, I'm not going to go too into depth with this, because I know it's probably a very covered topic. We've covered it on Twitter as well, but obviously some of you guys are just wondering what's going on here. Is this going to be an inflationary problem? And I laid it out in a Twitter thread. But long story short, as simple as I could put it, I don't think you should hold the same inflation risk to this whole Red Sea conflict as you are led to believe, because again, these macro pilled individuals have a very strong recency bias. They just saw inflation rip in their faces. Inflation was quote unquote transitory, but never stopped. It just kept going up, and it finally peaked at 9%. So they're like, okay, it's very easy for inflation to go up. So any little bump in the road, inflation is going to skyrocket. When in reality, this is not a global supply chain issue. Okay, this is an issue, like the supplies are still getting to the destination, right? It's not like we have a chip shortage. It's not like we have a mineral shortage. It's not like we have any of these raw material shortages. And the prices of the raw materials themselves aren't even up significantly with this whole situation. So you have to understand that the price of goods is not really rising. The price to transport the goods, of course, is up, as you can see by the chart. But the price of the goods that are making these products that are being transported aren't up a lot. So the problem here comes back down to this. Do the companies that are shipping, that have to go around the route of, go through the route that goes down around Africa, the costs that are incurred, obviously you can see them jumping, right? Do they eat the costs? Does the shipping companies, do they make a better margin on their bottom line? And is the loss being eaten at the corporate level or the shipping level, or is it being forwarded to the consumer? Is the consumer going to pay a higher price because a good went around the Cape of Africa instead of going through the Suez Canal? The question now is in America, right? This is not Europe. Europe's obviously a different story. We have to focus on America. If that good is going to cost more, then theoretically any company that doesn't have to use that shipping route, or is not being produced in that, or any company that's not producing goods in that area, would have a competitive advantage over that specific company now, right? Because again, this isn't a raw material issue. This is a shipping route issue. Can it be inflationary? Sure, if all of the goods stopped moving, but they're still obviously moving. They're not going through the canal. They're taking 2 weeks longer to transport. So the question now is any company that isn't operating in that space or in that region, they have the competitive advantage where they can basically underbid these people that are forced to pay up if they're going to pass that cost to the consumer. So again, this falls back down to this isn't as inflationary or a bottom line inflation driver as most would like it to be, because everyone's looking, these macro pill dudes or people are looking for this second inflation run. And unless you start to see a surge in inflation swaps, more importantly, we have an inflation index, a proprietary inflation index, and that has a trend component on it. If we see that trend component start shifting or start signaling a material shift, these are all signs of things that, okay, it's time to get concerned about inflation. But unless you see that, you're burning your own brain cells,
Yeah, I mean
wasting your
you're
time.
gonna see it in the inflation swaps. Like that, they're gonna know if inflation's being an issue, and right now inflation swaps are not thinking this is an issue at all.
Yeah, exactly. Thank you guys so much for listening. If you want to reach out to us, you can reach us at Twitter at the Market Radar or go to our website at market-radar.com. All of our models and our portfolio allocation layouts are provided in our daily updated quant deck, which access to can be found on our website. Thank you.